I mean, ultimately, that's what's going to happen. That's the path that we're headed down. It doesn't really matter who gets elected in November. We're headed towards monetization. If Biden gets reelected, we get there fast. If Trump gets reelected, we get there slow. But it's going to happen.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. We have a fantastic discussion lined up today that I'm incredibly excited about. Today, we're fortunate to have with us Jared Dillian. Jared is the editor of the Daily Dirt Nap, a daily market newsletter for investment professionals. He graduated from the United States Coast Guard Academy in 1996 with a focus in mathematics and computer science. Also from the University of San Francisco in 2001 with a master's in business administration and a concentration in finance. And recently from the Savannah College of Art and Design in 2023 with a master's in fine arts in writing. Jared worked for a small floor market maker on the Pacific Options Exchange from 1999 through 2000 and was a trader for Lehman Brothers from 2001 to 2008. Specializing in index arbitrage and ETF trading. He's a multi-time author, including a book called Street Freak, Money and Madness at Lehman Brothers, which was named Businessweek's #1 general business book of 2011, and his most recent book titled Night Moves, which is due out later this year. Jared, thank you so much for joining us today.
Hey, thanks for having me.
Yeah. All right, so let's begin with how you're seeing the world today. What has your attention, the market, the economy, geopolitics, wherever you want to take that?
Gosh, I mean, that's a pretty broad question. We're kind of in an interesting spot. The price action in stocks has been pretty soporific over the last couple months, going back to December. The price action has deteriorated a little bit, but we're still close to the all-time highs. You're hearing less about the Magnificent Seven because breadth has broadened a little bit and some of the big tech names have gone down a bit. The economy on the surface seems to be strong, but anecdotally, people are unhappy, right? And this is something I wrote about. This phenomenon has been going on for at least a year and a half. When I was writing for Bloomberg Opinion, I did a piece on this in the summer of 22. There is this disconnect between the real economy, the labor market, which is very hot, and people's claims about their feelings about the economy. We just got a new low in consumer confidence today. The PMI numbers have been horrible. Chicago PMI number was catastrophic today. So it's kind of a weird economy. I think a lot of the reasons why sentiment is so negative, pervasively negative, is because of what's going on in Israel and also Ukraine. I think geopolitical conflict has made people unhappy. And I think that political uncertainty is also adding to it with the election coming up. But this, I'm not really bullish at this point in time. One thing that I focus on is private equity. And I think we're in the midst of a private equity bubble that I think could pop. And I think that would have systemic effects. So I guess I'm short and medium term bearish at this point.
And what's your thoughts on the recent news after the 15th of the month that tax receipts have come in lower than anticipated?
Yeah, actually, I didn't know that. Thanks for telling me that, because that's a really, really good indicator of the health of the economy. Because ultimately, if people are paying taxes, they're making money. If they're not making money, they're paying taxes. I mean, taxes is the money that people absolutely have to pay. So to hear that tax receipts are coming in lower, I think adds to my thesis for sure.
Okay. And, I'm pretty positive, I don't have the data, but I'm pretty positive that a significant percentage of tax receipts is based on asset movements, right, on the market. So you would think with the market being elevated that tax receipts would have come in a little hotter than they did. But
well, I mean, capital gains actually makes up a smaller percentage of tax receipts than you think. I don't remember the exact percentage. I kind of had the same reaction as you. I would have thought that capital gains was a much bigger portion of the budget, but it's really not.
okay.
It's mostly income.
Okay. So the Goldman Sachs Twitter Economic Sentiment Indicator Index. So here you are talking about sentiment. It's the most bullish it's been in 4 years. It's also significantly higher than the University of Michigan Consumer Sentiment Index, but both are generally trending higher. I hear you when you say that you're not particularly bullish, but is the economy in a bullish cycle for as far as the eye can see?
I mean, it's funny that you mentioned that. I was on Twitter the other day and I saw that Ben Carlson tweeted that the return of the S&P 500 over the last 30 years is 10.1%, which is high. It's funny because I keep seeing this number ratcheted up. When I started investing in 1997, the S&P was supposed to compound at 8%. Then it was 9%. Then it was 10%. Gains in the stock market have accelerated in the last couple of years. So, but it's funny because, that tweet is not something you see on the lows, right? Like it's not something that people really tweet about in the middle of a bear market. So I think, did you say this was a Goldman Sachs Twitter sentiment index? I've never heard of this before.
Yeah, it's a Goldman Sachs Twitter Economic Sentiment Indicator Index.
Yeah, I would love to see how
overlaid. Yeah, it's overlaid on the University of Michigan Consumer Sentiment Index.
I would love to see how that's calculated. That's fascinating to me. I think you're right. I think sentiment on, I think people are pretty bearish on the economy, but I think they remain bullish on stocks, which is pretty interesting. But yeah.
Okay. So, Jared, with inflation still elevated, it's clear that current interest rates are just not restrictive enough. Debt servicing costs are skyrocketing as interest rates rise, but so is literally everything else. Markets, house prices, car insurance, everything is just rising. Not to mention all the money that is being earned by those who have substantial savings because of those higher interest rates. So, for instance, somebody had $1 million in a CD or money market a few years ago, earning a half or of 1%. They earned like $5,000 in interest. Today, they're earning literally 10 times that. They're about 50,000 annually. So that's a lot of extra money to spend into the economy, to give to their kids, to help with purchasing houses or whatever. If the Fed raises rates further, it seems like it'll only lead to greater inflationary impulses on all of that save money. If they lower interest rates from a position that's already not restrictive enough, it seems that would also be highly inflationary and cause assets to rise and markets. In other words, what can the Fed truly do here to lower inflationary impulses?
Well, I've seen this argument floating around about how the Fed hiking rates is actually in a perverse kind of way, making the economy stronger. If you go back to the 2010s, when interest rates were zero, people thought that the economy could not tolerate higher interest rates. And when we started getting rate hikes at the end of 2021, people thought that, if we had 1% or 2% Fed funds, that the economy would just collapse. And here we are with 5.5% Fed funds, and everything is great. And you can, and actually, if we can tolerate 5.5% Fed funds, then we can probably tolerate 7% Fed funds, right? And this feedback loop that you're talking about, I think one of the reasons this is happening is because when interest rates were low, everybody refinanced their mortgage, right? So
Mm-hmm.
even though mortgage rates are at about 7.25 right now, the average mortgage rate is at about 3.5. Like
Mm-hmm.
people refinance their mortgages, they're stuck in their houses, but they have low payments. And because we have fixed mortgage rates, people haven't felt the effect of higher interest rates. And it's going to take a long time for that to feed into the economy. So I think that's what's going on. And just like you said, somebody in a money market fund is now earning 5.5%. You know, if they have $1 million in cash, it's 55,000 a year. Like it's kind of counterintuitive.
Yeah, very much so. So it just seems like if they raise, which seems like they need to because the rates don't seem restrictive enough. But if they raise, there's a lot of people sitting on a lot of cash that's going to have a lot of extra disposable money to funnel. It's almost like a stimulus back into the economy.
Yeah, it really is. And, if you go back to the fourth quarter of last year, we hit a rough patch in the economy. We got some soft data. And at the time, Fed funds was at 5.5 and core PCE was at 2.5. So we had real interest rates of 3%. And the Fed looked at this and said, you know what, like this is overly restrictive monetary policy. And then you started seeing some speakers like Christopher Waller talking about cutting interest rates. And then for a period of time, we priced in a whole bunch of rate cuts, like 8 rate cuts in 2024. And we've walked most of that back. I think that the path of interest rates depends highly upon the election. I think if Biden wins, it's going to be kind of more of the same, higher for longer. We probably will get some rate hikes out of the Fed. If Trump wins, he's going to put a lot of pressure on the Fed to lower interest rates. I think if he wins, I think we've seen our last rate hike for a while. So.
Well, that's interesting. Yeah, I know he pressured or attempted to pressure the Fed, back in 2018 or 2019 to lower rates. So I that kind of supports your thesis there.
Yep.
Yeah. So the stock market seems to reach, new highs all the time. Some believe it's overstretched and in a bubble. Others believe we're in a new bull market and the valuations are right where they should be. And even others believe that our new inflationary environment is leading the markets on a path to, 100,000, a Zimbabwe effect, if you will. What's your take there? In such a world, what should we expect regarding inflation-linked asset prices moving forward?
What do you mean by inflation-linked asset prices?
I would put gold. I would put oil. I would put things like that.
Well, I mean, technically, we put in the bottom in commodities for sure. We've had a couple of commodities go parabolic in the last couple months in the softs. You've had orange juice and cocoa, and now coffee is starting to go parabolic. Copper, the chart on copper looks phenomenal. Copper looks to be taking off. I mean, gold went vertical as of about a month or two ago. Getting a little choppy up here, but I'm still bullish on gold. Oil, I'm a little surprised it's not higher, but oil is probably in a bull market. Really, the only commodities that haven't responded are the ags. Really for reasons specific to agriculture, but corn, wheat, and soybeans are still on the lows and haven't participated yet.
So you expect that to continue as long as we have inflationary impulses, as long as inflation stays higher for longer, you expect some to many of these commodities to continue to remain elevated, continue to move higher?
Yes.
Yeah. All right. So, Jared, recently the Secretary of the Treasury, Janet Yellen, stated that outright seizure of Russian assets is justifiable by law. With that as the backdrop, why would anyone, meaning other countries, buy treasuries anymore? Like, why not just buy gold and call it a day? It can't be seized.
I mean, that's kind of a rhetorical question. That's obviously what's going on here. A lot of foreign central banks and foreign governments are buying gold because it's outside the financial system and can't be seized by the U.S. I mean, if we can arbitrarily seize the assets of any country, and I think the number in Russia is something like 300 billion or something like that.
You're right.
So, everybody is pretty much diversifying into gold at this point, and that is that is the law of unintended consequences in full effect. And in fact, we should have seen this coming around the invasion of Ukraine when we placed the sanctions on Russia and we cut them off from SWIFT and we did all this stuff. We kind of should have seen this coming.
Yeah. So how much of a danger to our debt market is it that the foreign nations are not buying as much of the debt or not, as they were, while at the same time the U.S. is seizing assets from foreign nations, and simultaneously the amount of debt that the Treasury is issuing is growing so rapidly?
Well, foreign holdings of U.S. Treasuries are, I think, smaller than you think. China has sold it a lot. China has liquidated about 60% of their U.S. Treasury holdings already.
What do they hold? 800 billion at this point?
I think it's less. I think it's like 460 or something like that. It's a lot less. Okay. So they and they did most of that in the last spike in interest rates when Treasuries just could not absolutely get a bid. A lot of the selling was coming from China. Japan holds about $1 trillion. And that seems to be stable for now. They're an ally of us, but also, if they're defending the yen, they have to be selling treasuries to raise dollars to buy yen. So they might be selling treasuries. So, but getting back to my original point, foreign holdings of U.S. debt it's pretty small relative to the entire total.
So what do you see moving forward for the Treasury market, for who's buying the debt? Are they going to impose it onto the banks, maybe even onto pensions, et cetera?
Well,
or are they just going to monetize it?
Ultimately, that's what's going to happen. That's the path that we're headed down. It doesn't really matter who gets elected in November. We're headed towards monetization. If Biden gets reelected, we get there fast. If Trump gets reelected, we get there slow. But it's going to happen. Like the deficit situation is totally unsustainable. And it's been unsustainable for a long time. And people 25 years ago were saying that this was going to happen, and it's taken 25 years. And in finance, things take a lot longer to play out than you think. But if we start running $3-4 trillion deficits next year, the auctions are going to get sloppy. There's just, people are going to have to receive a higher interest rate to compensate them for the risk, right?
Yeah. So, Jared, we all see the headlines that China, Russia, and many in the Middle East, including Saudi Arabia and others around the world, are now beginning to forego using the dollar to settle their trades and instead are using their own currencies and settling the differences in gold. How much of an issue is this? And are there going to be ramifications economically? But I'm concerned about the average American. What are they going to feel moving forward?
I think that the effort to move away from the dollar is not really something that people should focus on. The dollar is absolutely ingrained in world trade. I don't think we're going to be moving away from it anytime soon. Smartest thing.
Does a decrease in utilization matter?
Maybe at the margins, but really the only way the dollar loses its reserve currency status is if we lose a war. Right. Like let's say we go to war with China and we lose, the dollar is no longer the world's reserve currency. The way I heard it phrased was that if the United States loses an aircraft carrier, then the dollar is no longer the world's reserve currency, because the Navy is how we project power across the world. And if you look at which countries have had the world's reserve currency, Britain had the world's strongest Navy. They had the world's reserve currency. Mm-hmm. And before then, it was Spain. So when you lose a naval war, that is the time that you get another reserve currency. So
that's interesting. And you think about how China is building up their Navy. Maybe they're seeing, they see the history of that. But, I agree with you. I'm not, in the camp of the United States losing the dollar as a reserve currency, but more from what's the chances of it going from a unipolar to a multipolar reserve currency? And is there implications of that?
I don't think that's going to happen anytime soon. I think it's a very slow process. I don't think it's going to happen anytime soon.
Okay. So China has experienced their most troubled economy in decades. The real estate sector has blown out. They've aligned strongly with Russia, causing less investment dollars to flow into their markets. On the flip side, they've been stockpiling commodities like they won't have access to them sometime soon. And there's been some chatter about them devaluing their currency. Can you speak to what's happening with China and how you see it impacting the dollar, the economy, et cetera?
I'm a China bear. I'm very bearish on China. China, I know is completely run top down by Xi. Okay. There's no room for dissenting opinion. It's dysfunctional. There is the stock market, by the way, is actually rebounded a bit. So, the Shanghai index is above the 200-day moving average, and the stocks, it was in free fall for a while, but it's bounced a bit. I have never invested in China, and I never will. I absolutely never will. I think that there is a possibility that China won't even have a stock market in 10 years. Okay. Wow. And not really from an ideological standpoint, but look, it's a communist country. And when the stock market becomes an embarrassment, when the government starts to lose face over the performance of the stock market, I don't think she really cares about capitalism. I think there's a chance that everything becomes a state-owned enterprise. And I'm not talking about like 2024 or 2025, but like 5-10 years from now, I think that could happen. So, and a lot of people, I run into a lot of people who like, oh, it's oversold, I'm going to buy it for a bounce and stuff like that. Like, I'm like, you're missing the bigger picture here. Like it's in big trouble. So.
Is there an emerging market or another nation out there that you really like the demographics, you really like the resources, you really like the setup, the way China moved over the previous 20 years and just grew exponentially? Is there another nation out there that you see from today moving forward that you like? I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all of the expert interviews that we conduct. And when you subscribe, we want to give you a free gift. It's the report that we wrote based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address, and subscribe and receive the free gift on us.